Hello and welcome to another episode of the Oracle's Classroom. In this episode, we're going to be taking a look at Berkshire Hathaway's balance sheet and examining the debt on the balance sheet in relation to its earnings, assets, and equity. So we'll just start with the liabilities section of the balance sheet here. And I've bounded in red the insurance liabilities. And they're real liabilities, but they function differently because Berkshire's insurance underwriting operations continually bring in funds that essentially make this a revolving fund. So nothing that Berkshire can do will cause these amounts to be to have to go out to have to satisfy these immediately. So they're different than true debt. They are true liabilities, but they function in many cases like equity, which is actually another video topic entirely. But in this video, we're going to be focusing on the green here, the true actual borrowings, the true debt of Berkshire. So this is the consolidated view, and we can see in the insurance and other segment, most of this is related to the finance operations, and a little bit of it is the manufacturing, service, and retailing businesses, which have some debt, which we'll get into in a minute. And then the railroad, utilities, and energy businesses have a significant amount of debt in relation to, I guess, the typical company, but because they are more utility-like, explicitly or in function like the railroad, they can handle more debt, and we'll get into that in a minute. But we can see that just on a very high-level basis, the debt that Berkshire has is modest in relation to its equity capital, and so 419 billion of equity compared to 411 billion of total liabilities. Now, the case could be made to subtract the intangibles and goodwill from the asset side of the balance sheet, but assuming that Berkshire has paid an appropriate price for its subsidiaries and that reflects the true value of them, we can be pretty confident that equity figure is solid. So that's the high-level overview, and we'll dig in some of these in just a second. Here we can see the first section, the debt in the insurance and other segment. And just to point out, the first three line items here are borrowings at the parent company level. So these add up to about 22 billion. And this is money that Berkshire has borrowed, to finance certain acquisitions or just to borrow for general purposes because it made sense. And we can see the weighted average interest rate on these, on everything here is quite favorable. But even so, at the parent company level are lower, which makes sense because Berkshire at the parent company level has access to the earnings from all its subsidiaries. The other segment, the next two from Berkshire Hathaway Finance Corp. I won't read the detail, but this note 16 continued, which is I believe on page 19 of the 10Q, details some of the debt, what it was used for, and what it finances. So Berkshire Hathaway Finance Corp. Is essentially an entity that's set up to borrow money in the public market and then relend it internally to those businesses that essentially act like banks. So you have one of the first that Berkshire purchased in this area was in Scott Fetzer. So it's World Book encyclopedias, as well as Kirby vacuums were financed by a separate entity, Scott Fetzer Finance Corp. And that in over time turned into this Berkshire Hathaway Finance Corp. To relend, to borrow and then relend. But another big one under Berkshire Hathaway Finance Corp is Clayton Homes. In fact, that's probably the bulk of it, which Clayton builds, but the bulk of its business is actually financing the homes of its customers as well as others. So that's a big part there. And then the other subsidiary borrowings, those are uh, finance, true debt for the manufacturing, service, and retailing businesses. And then the short-term borrowings are just lines of credit and things like that, commercial paper, and some rare instances for some of these subsidiaries. But in relation to the earnings and assets of those businesses, these borrowings are very, very modest. We'll next turn to the railroad, utilities, and energy businesses. And this is broken down into the two main segments, Berkshire Hathaway Energy and the railroad. And the first thing we notice here is that so Berkshire Hathaway Energy is a lot like Berkshire Hathaway in that it is a parent company that has other subsidiaries. So that parent company has borrowings of its own, and then the subsidiary individual units have their own borrowings, and then there's some short-term borrowings as well. The interest rates are slightly higher because Berkshire Hathaway, the parent company, does not guarantee any of the debt of either of these, the utility business or the railroad. So they pay a slightly higher rate. But we can see that combined, the $68.8 billion for those two entities alone, which, we really don't have all the information yet. Until we know what the earnings of these businesses are, we can't really make a judgment as to the appropriateness of the level of debt for these businesses, as well as their assets as well. So we'll turn to that next. So now we'll turn to sort of an overview here. And again, we're not going super into depth. There's a lot more nuance to all of this, but this is really just a high level look at Berkshire's debt. So we can see the first entry, Berkshire Hathaway Energy, its debt of 46 billion. How do we think about that? So in the next column we have its earnings of 6.4 billion. Now there's a couple different ways you could look at this. You could use net income. You could use pre-tax income. I've chosen to take the figure of cash flow from operations, which does not exclude or deduct depreciation. The fact that Berkshire Hathaway Energy, its assets are very long-lived, and it finances appropriately its assets with debt, and that includes major capital expenditures because they are so long-lived. So I've used the figure from Berkshire Hathaway Energy's own Q3 trailing 12 months report, a separate presentation that they have out there publicly, of 6.4 billion. So we can look at that and say 7.4 times, or it would take about 7.5 years for Berkshire Hathaway Energy to repay the debt that it has. Then we turn to the railroad, and here I've chosen to use the after-tax, the net income figure for BNSF, which would repay its debt in 4.2 years. Now, Berkshire Hathaway, the BNSF used to put out a computation of fixed charges, its ratio of earnings to fixed charges, which actually would include depreciation. Because of the railroad, it's a significant ongoing annual expense. And that ratio was typically close to, if not exceeding 10 times. In some cases, that was 20 times. So that's another way to look at the debt. It's more appropriate, if you were a lender to BNSF or Berkshire Hathaway Energy, for that matter, you would want to take a look at what the contractual obligations were of those entities, the specific amounts due, and figure out if it could actually meet it from a cash flow standpoint. So we're just looking at after-tax earnings, which pre-tax earnings can receive a benefit from the deductibility of interest expense, but we're just looking at a very crude measure here of the after-tax earnings, because after-tax earnings repay principal on debt. So here we can see 4.2 times, which would indicate, again, from a high level overview, maybe a little bit higher than another company that was more conservatively financed, like some of the MSR businesses. But because BNSF, it's not quite a utility, but it's very close to utility compared to other businesses with its stable earnings. We can then turn to so the insurance and other. This was sort of tricky to do because it's not separated out specifically. So do you include the specific earnings from, say, the MSR businesses? Should you deduct the corporate overhead, corporate interest, and so forth? So I've left that segment blank for the earnings for that. If you just use the MSR businesses, that's, a $10 billion roughly annual rate. The coverage is quite good. So what I've chosen to do and we'll just focus on the total, the 108 billion of debt, and then I've plugged in for 2019 the after-tax operating earnings, which come from the news release that Berkshire puts out. You can also calculate that figure directly from the figures in the 10K. Now, as of 2020, the earnings power may have declined a bit, but we look back over a couple of years, and that after-tax operating earnings is right around that 25 billion. And then you take another step back and you say, okay, well, so that's an earnings-based analysis essentially. And what else does Berkshire have? Well, it has 146 billion of cash on the balance sheet. So Berkshire, it could repay all of its debt, just write a check essentially and repay those. But it doesn't do that because the interest rates that it pays are modest. And, now is a great time to borrow. The debt in relation to the assets and equity as well as earnings are modest. And so those businesses are good on a standalone basis. They're financed conservatively, and Berkshire has cash available as dry powder to invest in other operating businesses. So that debt, the cash is available to repay debt, for whatever reason, if it needed to. Its earnings are very stable, so that is probably very unlikely earnings would be sufficient to repay the debt. But cash is always there as a backstop for the insurance liabilities as well as the debt. But it's also there for future investment opportunities. So Berkshire would have that cash available to put into work and generate additional after-tax earnings. So from that standpoint, Berkshire is very, very conservatively financed. Its obligations, it's taken great pains to structure all of its obligations such that it cannot be called on to put up any significant amount of cash at any time. And too long for this video, but we could dive into, if anyone's interested, we can dive into the specifics of the debt structure of the energy business, the railroad, or the others. Most of those documents are public because they are publicly traded debt. You can see what the lenders have put in there for covenant requirements, what the business can borrow in relation to its earnings. Most of the debt is unsecured, but in some cases, it's guaranteed by the parent company or secured by certain assets. So there's a lot more to it, but this is just a very high overview of Berkshire's debt. I hope you enjoyed it. Please share the video, like this video, and if you haven't already, please subscribe to the channel. And please let me know if you have any questions, anything you'd like to see, any requests, things like that. It's a continual learning experience for me as well as others. We continue to learn from Berkshire Hathaway and about Berkshire Hathaway, and take those lessons to be used elsewhere in our investment journey. So thanks again for watching, and we'll see you very soon.